Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 1, and this is Section E. This is an application topic, prepare financial statements using the income tax basis of accounting. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions. If you don't know much about our strategies, that is one of the main ideas is instead of watching lectures, instead of reading the textbook, most of your time is spent diving into the questions and the sims to learn how they work, to learn the material that you need to know, because what are you going to be doing on test day? You're going to be answering questions and doing sims. So why not do what you're going to be doing on test day? So that's one of our main ideas. And if you want to learn more about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam, and we will show you how to be effective and efficient with your studying so you don't waste months or even years of your time. And as we get into these questions, just letting you know, we will only be going over 4 questions in today's video. And normally there is a member version of the video, like a pro version of the video, where we double the questions so you can get a little bit more practice and a little bit more help if you are a pro member, and we post that in the members forum. But for this video, we're only doing 4 questions and that's it, because the scope of this topic seems to be fairly small, so there's not too much to cover. And I feel like most of the income tax type of stuff that you're going to be learning on FAR is further into the blueprints, so we'll be covering that when I get to that when I make the videos. So we're only going to be going over 4 questions, but normally members have access to the full video where again we typically double the questions. Typically it's 10 questions and you can get more practice. So if you like this, you can get more of it by becoming a pro member of SuperfastCPA. With all that, let's dive straight into the questions. All right, here we are at question 1. When preparing financial statements using the income tax basis of accounting, how does this method differ from the cash basis and accrual basis of accounting? So as you read through these different options, which one of them sounds like something that would make sense? What is the big difference between income tax basis of accounting compared to, cash or accrual? We've been talking a lot about special purpose frameworks, and this is one of the special purpose frameworks. So the financial statements are a little bit different. They'll have a little bit different titles, but what even does it mean to have an income tax basis financial statement? If you don't know the difference between this, that's okay. We're going to go straight to the answer to kind of get an understanding of what we're learning in this video. All right, here we are. The answer is B. Income tax basis requires using methods and principles for preparing a tax return, leading to special treatment for certain non-taxable revenue and expenses. So that makes sense. If you are preparing financial statements on tax basis, then you're going to be doing it similarly to a tax return. Income tax basis of accounting uses the methods and principles applied in preparing a tax return. That makes sense. This means that some revenue and expenses that are non-taxable are treated specially when preparing financial statements and recognized differently depending on the typical basis in the business uses for revenues and expenses, such as cash or accrual. This doesn't necessarily mean that these items are completely ignored, making D incorrect, because it was saying to just completely ignore them, you don't put them at all, when in reality you still have to do something about them in the financial statements. You still have to keep track of them in some way. So we're going to spend the next few questions kind of talking about these non-taxable revenues and expenses, and also some of the other differences that there are for tax basis compared to maybe accrual or something like that. But just know, with just this first question, one of the big differences is that because you're preparing it on the same methods and principles that you would a tax return, there are some revenues and expenses that are non-taxable. So you have to treat those a little bit differently. So let's go to the next question to kind of learn how you would typically treat those. All right, here we are at question 2. And as we get into this, one thing that we always like to point out is a great strategy is to read the last part of the question. Now, it's a little bit silly when you have such a small question, but it is a good habit to be in. So which of the following is not an option for how to treat this non-taxable item? Okay, so that would give us context for what we're looking for in the rest of this. A company received $10,000 in municipal bond interest income during the year. So when we're preparing the financial statements using the income tax basis with this municipal bond interest, which of the following is not an option for how to treat it? So can we exclude it from the revenue entirely and just disclose it in a note? Can we include it as just a separate line item? Do we report it as an addition to net income, or do we just include it in taxable revenue like normal? How do we do it? There's 3 of these that are apparently correct. One of them is wrong. So let's go ahead and dive into the answer to learn what this even means. All right, here we are at the answer D. Include the $10,000 as taxable revenue in the income statement. That is something that you cannot do when you are preparing income tax basis financial statements. So let's kind of read through this to understand that. Under the income tax basis of accounting, non-taxable items such as municipal bond interest income can be treated in several ways. They can be excluded from revenue entirely and disclosed in the notes. So in the previous question, there was a possibility of just completely ignoring it. Now, you don't totally ignore it. Even if you don't include it in the financial statement, you have to have a note saying that these were the non-taxable items. You could also show it as a separate line item in the income statement. Now, what does that mean specifically? You don't need to dive too deep into that because, again, this is a pretty small topic for the FAR exam. Everything with income tax seems to be a lot more focused on what we're going to be covering in FAR Area 3, talking about, tax income expense and deferred assets and liabilities and things like that. So the main idea is that you just need to know that it can be shown as a separate line item if it's non-taxable. Or you can also report it as an addition or a deduction to net income. So what does that mean? You take this non-taxable income, you don't include it in the taxable revenue, you just add it to net income so that you are still including that in the net income, but you don't have it in the taxable portion of the income because remember, net income is post-tax. It's after your taxable income has been taxed. So you can do these three different things. However, they should not be included as taxable revenue, as this would misrepresent the company's taxable income because including it as taxable revenue contradicts the whole point of the tax-exempt nature of the income, and therefore it doesn't really align with tax basis accounting. So you can't include this non-taxable income in the taxable portion of revenue. You can, again, treat it as a separate line item. You can treat it as something that's just disclosed in the notes, or you can add it to net income after you've already taxed the rest of the income, but you can't have it as taxable income. Common examples of non-taxable items would include municipal bond interest, life insurance proceeds received upon the death of an insured employee, certain types of dividends received from domestic corporations, and expenses related to these items. So these non-taxable items of income and then maybe the expenses that are related to those, they will be treated a little bit differently on an income tax basis. These items do not contribute to taxable income and therefore require this special handling that we just barely talked about. So that's one of the big things that you need to know for this small topic. Let's go to the next question. All right, here we are at question 3. As always, it's a good idea to read the last part. When preparing financial statements using the income tax basis of accounting, how much of this $8,000 will be included in taxable revenue? Now, something that we just learned from the previous question, you should already know the answer to this without even reading the rest of this, but let's go ahead and read it. A company that typically uses the accrual basis of accounting purchased a life insurance policy on an executive. The executive passed away on April 12th, and the cash was actually received on June 30th of the same year. Now, knowing that information, when we prepare it on income tax basis, how much of this should be included in taxable revenue? We kind of already talked about this. Pause the video if you need to. If not, that's okay. Let's go ahead and just look at the answer together. All right, the answer is A, $0. So again, we pretty much already got the answer for this in the previous question too. So let's go ahead and read this. The $8,000 received from the life insurance policy on an executive is considered a permanent difference for tax purposes. So I just wanted to point out this permanent differences, and we're going to talk about temporary differences a little bit. Again, this is not something you have to dive into very deeply at all for FAR, but I just want to make sure you understand what permanent differences and temporary differences are generally, just in case this helps you kind of figure out things when you're doing this topic or when you're doing the topics further into FAR, again, where we're talking more about income tax again. Permanent differences are items of income or expense that are recognized for financial accounting purposes but are never included in taxable income or deducted in the computation of taxable income. This means such items are excluded from taxable revenue permanently, regardless of the basis of accounting used or the timing of recognition. So in this scenario, even though an accrual basis company would typically recognize revenue as soon as it was earned, so again, they're an accrual company and the executive passed away on April 12th, which means that the policy goes into effect as of April 12th. They would recognize it on that date, and a cash basis company would recognize it when received on June 30th. That's when they got the cash. The $8,000 in life insurance proceeds is non-taxable. This is something that's non-taxable. It is actually a permanent difference. It will never be included in taxable revenue on an income tax basis financial statement. So this is not ever going to be a taxable item. It will instead be treated like we were talking about previously. We could either have it as a separate line item, in addition to net income, or just as a disclosure. But it's not going to be part of taxable income for these financial statements. So again, we're not going to dive super deep into permanent or temporary. We're going to do one more question that talks a little bit about temporary. Let's go to the next question to learn a little bit about temporary differences. All right, here we are at question 4. As always, it's a good idea to read the last part. When preparing financial statements using the income tax basis of accounting, how much depreciation expense should be included in the current year's taxable income? Okay, so Now we're talking about depreciation. How much of it is going to be included? Let's read this. A company that uses the accrual basis of accounting purchased equipment for $50,000 on January 1st. For financial reporting purposes, the company uses straight-line depreciation over 5 years, but for tax purposes, it uses an accelerated depreciation method that allows for $20,000 of depreciation in the first year. So if we're doing income tax basis financial statements, which one of these are we going to use? Is it going to be the straight line depreciation? Is it going to be the accelerated? Or is there something different randomly that you would not recognize it or that you would fully expense it? Now, I think it's pretty easy to tell what you would probably do, so I won't really talk about it that much. You could probably guess they're just going to use the accelerated depreciation if they're using the income tax basis for preparing these financial statements. So let's go ahead and look at the answer. And yes, the answer is the $20,000 per accelerated depreciation. So let's read through this. Again, we're talking a little bit about temporary differences, just so you know these are some things that might come up if you're preparing something on tax basis financial statements compared to maybe cash or accrual. The difference between straight line depreciation and accelerated depreciation represents a temporary difference in accounting. Temporary differences occur when an item is recognized in one period for financial reporting purposes, but in another period for tax purposes, leading to differences between taxable income and accounting income in different periods. Unlike permanent differences that we talked about in the previous question, temporary differences like this one will reverse over time, as the total amount of depreciation recognized for both financial and tax purposes will ultimately be the same. So it doesn't really matter in the end. Just for these tax-basis financial statements, you're recognizing more depreciation right now, but as you prepare them throughout the rest of the years, by the end, you will have recognized the same amount of depreciation as you would have recognized if you had just prepared this on normal financial statements like accrual financial statements. Again, we're not going to dive any further into that for the temporary or the permanent differences or the non-taxable items. The basic idea behind this video was to show you the small differences if you do get tested on income tax basis financial statements. Let's go ahead and do one more part of the Superfast CPA process before we finish up, called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions, you will notice the things that keep popping up. You will notice, hey, I've seen 4 questions trying to teach me about this specific topic, or I haven't really seen any questions about this topic. Maybe it's not going to be tested that heavily. That's probably going to be the case with this topic. You will probably not see very many questions on it. It's probably going to be something that you maybe see more in the notes or the lectures. So sometimes if there's a topic in the blueprint and you don't see very many questions about it in your review course, that's a good time to look into the lectures or look into the review book. But overall, you can learn most everything you need to know from the questions. But that's the idea behind Pillar Topics, is as you're going through the questions, or if you have to supplement with lectures or reading the textbook, you pick out the most important things and you summarize them in your own words so that you know how and know what is most important. So let's go ahead and look at the Pillar Topics for this video. All right, here we are at the Pillar Topics. Again, not too complicated, not too deep. First, there's the income tax basis versus cash and accrual. Income tax basis financial statements use methods and principles from tax returns, leading to special treatment for certain revenues and expenses. That makes sense. Non-taxable income and expenses, items like municipal bond interest and life insurance proceeds, are not included in taxable income, but can be reported as separate line items, additions or deductions to net income, or disclosed in the notes. So you still have to report these somehow on these tax basis financial statements, but they're non-taxable, so you can't include them in the taxable portion of revenue/expenses. Now, when it comes to these differences between income tax basis financial statements and cash or accrual basis financial statements, just letting you know, these are what's called permanent and temporary differences, as in they are going to be different than what you prepare on a normal financial statement, like a normal book financial statement. Permanent differences are similar to these non-taxable items. In fact, non-taxable items are permanent differences. They are items that are going to affect financial accounting but never impact taxable income. So again, they'll be noted somehow in the financial statements if you're doing income tax financial statements, but they're never going to be a part of taxable income. Then there's temporary differences, where that really just means that as far as income tax basis financial statements, you're just preparing it a little bit differently, but it's still included somehow on the financial statements. It just might be a little bit more depreciation compared to the normal financial statements or whatever the case may be. Again, overall, this topic is not a super big topic on FAR, so we just are doing a small video here to talk about it. Essentially, the thing you need to remember from this topic when you're going to the exam is if you see anything about preparing financial statements on income tax basis, just know that there are non-taxable items that are going to be treated differently. You may have to deal with some differences in timing compared to maybe accrual financial statements. But overall, not a super big topic, so that's why we're only doing 4 questions today. And with that, that is actually the end of the video. I know this was a smaller video, but if you like this video or our other videos that we make sure you go check out our free 1-hour webinar training on SuperfastCPA.com. We will teach you more about our strategies, and we will teach you some of the key ingredients to passing the CPA exam so that you don't waste months or even years of your time, and you can study more effectively and efficiently. So make sure you go check out that webinar. Also, just remember, normally these videos have a longer version that pro members can access. So if you become a pro member, you'll get access to more videos and more practice. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.